That is where we begin with the big issue. It's the bond market flashing a warning sign.
Indicators of fears of recession that are closer than people would expect.
We have probably the riskiest credit market that we've ever had.
The panic is showing up in the bond market.
It has been kind of a home run indicator in the past.
The bond market is responding to weaker economic data.
People are fearing a bad outcome for growth.
Lackluster growth.
Growth is slowing.
We do have a slowdown.
The downside risks to growth have certainly increased over the last couple of weeks.
This is what the market's trying to do, just recalibrate to how much risk we should be pricing in.
The yield curve inversion that we've seen could be reflecting some just broader weakness in fundamentals in the rest of the world instead of the U.S. in particular.
We have below trend growth in the Eurozone. We have weak growth in Japan.
There's nowhere else in the world you can go.
It's joining us to discuss here in New York, Priya Misra of TD Securities, Woodard of Bank of America Merrill Lynch, and Stephen Liberatore of Nuveen. Guys, great to have you with us. Your thoughts, Priya?
So we've had this perfect storm in the Treasury market. You know, I think we realize that this trade war is sort of with us for a long time. Plus, we had some signs of essentially slowing U.S. growth. I think the tension really in the market is that are we growing from, or are we going from a 3% GDP to a 2%, or are we actually going to 1%? I think the Treasury market is saying that we're going much below 2%. The Fed needs to ease. If you sort of decompose price action in Treasuries, it's been led by I would say a few things. Number one, we've actually priced in now 3 rate cuts between now and the end of next year. Number 2, TIPS break-evens have declined significantly. Number 3, term premium is at all-time lows. So it's a combination of the safe haven demand for treasuries plus this idea that actually growth is slowing. The Fed will need to ease. I'm not sure we actually have that data that we are heading into a recession, but I think, you know, the next couple of months it feels pretty pivotal here, because I don't think 2.25 is sort of sustainable. I think 240 is sustainable, but either we're going to 150 or we're sort of going back to 250-ish, I would say.
Jared, do you think we're going to 260?
That's the house view, and I agree. I think Priya's right. I mean, sometimes the bond market is the smartest market in the room. Sometimes the bond market can be wrong. And there's a very simple reason why you may be seeing portfolio flows into treasuries, and that's, you know, look at how strong the dollar is. The dollar is too strong. You know, if to the extent that you see people kind of around, around markets these days torturing yield curve charts, trying to predict recessions, trying to squeeze this out of data. Look, the Fed is not stupid, right? They see, all the same data that we do, and then some, and they know these risks. They're not going to let a liquidity squeeze or a credit event or some other kind of big market catastrophe destroy, the real economy.
Steve, quite clearly, and I was catching up with PIMCO yesterday, there is a huge risk-off bid going into treasuries. If you want some protection, duration, U.S. Treasury duration seems to be the place to be at the moment. Is that right?
Yeah, it sure seems that way. I think people are coming around to all of the various factors and uncertainties that the market has really been ignoring up until now. We've had declining global growth. We've also had just tremendously a more unstable environment, both geopolitically as well as with trade tension. So I think for a while, when the economic data was a little bit better, I think people were able to put past those concerns. But now that you're seeing the data kind of back up this move tighter in Treasury yields, it makes a lot of sense.